Hey, Bulls and Bears, back with another dose of economic reality. My name is JJ. You're watching Bull, Boom, Bear, Bust. Today is Thursday, May 11th, 2023. A lot of huge news to get into. We've got so much evidence now, and we've always had a lot of evidence. But today we have another stack of evidence that the economy is declining and it's a slow motion economic collapse. Anyone doubting that at this point? There was a survey put out, a week or two ago. We talked about it here that half the people now don't trust the banks. More than half of the population believes now that they're in a worse financial position than they were before 2020. But yet we still have people out there saying everything's fine, everything's normal. In the meantime, we've got fires going on in the background. The house is burning down, but they're saying everything is fine. But let's talk about more closures, right? And we mentioned this here in a previous report. 400 different Burger King locations are going to be closing, citing lower profits and higher operating costs, right? So this is a combination of inflation and deflation in the consumer's checking and savings account, right? Declining savings for consumers, wages not keeping up with the rising cost of living. So obviously we're going to see a lot more of these things happen down the road. And I had to pause it there for a second. I got my headset on. I've got some equipment running in the background. I just had to turn on a fan. It's actually starting to get hot here in Southern California. Not really hot, but in the 70s, and it's kind of stuffy in this garage here. But a store that I was at recently, little Mother's Day shopping, was Kohls, and I couldn't believe how empty the store was. This is like at 4:30 p.m. in the afternoon. And I think in the whole store, it's a pretty big store. And I think in the whole store, there might have been 8 people, including myself. And the prices were just ridiculous. Now, I don't know if they're price gouging, but they have competition from a lot of people buy their clothes now at Walmart and Target, which are a lot cheaper than what Kohls is selling clothes for. Now, hopefully Kohls clothes are a little bit more sturdy and better quality than what you can get at Target or Walmart. But our people on the type of budgets that they're on now with the economy, with everything costing so much, wages not keeping up, people's checking accounts being drained because the cost of living, are people going to continue shopping at Kohls? What have you noticed at that store? I mean, I think that Kohls is going to have some big trouble going down the road. I couldn't buy anything there just because, sure, I could have put it on a credit card and still paid the card off in full each month. I'm blessed to be able to do that. But I just don't like overpaying for things. I don't like giving business to businesses that don't give good deals. I like to reward businesses that give good deals. I like to try to give my money to businesses that I think deserve it. And, some people say, well, you're going to shop at Walmart all the time if you just want lower prices. Well, sure, you might get lower prices, but you also have to have quality. I also factor quality into, the type of shopping experience that you can get. You can go out and buy a car with 200,000 miles, but cheaper isn't always better is what I'm saying. So I think Kohls is going to be another retailer, and I'm not telling anyone to sell the stock. I'm not giving investment advice. This is just what I saw at my particular location here in San Diego. The store was dead. Prices were outrageous. Anyways, let's get into some other big economic news here. And a big story, of course, that we've been talking about and that it's all over the financial news is the bank runs, and the banks are still losing. The smaller and regional banks are still losing deposits in a major way. We've got PacWest Bank, and we've got the results here from the week ending May 5th. So we're still waiting to get the current week's numbers, but the week ending May 5th, we see that deposits declined about another 10%. That's Pacific West Bank. And there's a bunch of other smaller and regional banks I think are waiting. Dominoes waiting to fall. When you look at how big the outflows are and how many people are taking their money out of these banks. And, if you have your money in these banks, maybe say a prayer that the powers that be are going to reimburse you for your money. Even less than $250,000, I wouldn't trust it right now. When you look at how much money FDIC has and how many total deposits that they're supposed to be insuring, they only have a fraction. I believe it's less than 2% of the total number of deposits that they're supposed to be insuring. So now you're going to have to go to a combination of the Fed and the Treasury and get everyone to agree on if you should get your money or not if your bank fails. I'm not giving advice, but I'm just saying the numbers, the math doesn't add up as far as you being protected at any bank, even the too big to fail. So the money's just not there. It's going to be more debt that they're going to have to bring in to make these people whole if these banks fail. Now let's talk about what I think is a pretty ridiculous situation here, and that's what the Fed has been telling us, right? We go back a couple years, we see all these false predictions and narratives. It started with inflation. Well, this goes decades back, but just talking about here the past few years since the 2020 health crisis. First, it was the economy is recovering. Remember that. There's a recovery. Okay, everything was shut down. Now we're recovering. That was the narrative. Then we saw inflation tick up. We saw wages not keeping up. We saw people couldn't be taken off all of the rescue programs, and rent forgiveness is still in place, or rent eviction preventions are still in place in many cities, even as of today, 3+ years after the onset of the health crisis. Still in place. We see loan payments have been paused for certain things. Look at student loans. The crisis has not been solved. In fact, a lot of programs that were implemented are still in place. They cannot be taken away. So then the narrative was that inflation was temporary or transitory. Now, more recently, in March, we were told that the bank fear or contagion was going to stop, that there was no longer any possibility of any other banks failing. Well, we've already seen that wasn't true with what happened here just in the past few weeks. But now we've got a test out of the Fed. Fed report, bank stress is a top concern regarding financial stability. Bank stress is a top concern regarding financial stability. So it went from there's no concern, or that there's no fear of contagion, to now it is a top concern. And that's right out of the central bank, right? So how do you make this up? This is just wacky world type of just opposite information that we're being told. Like, what do you believe? Who do you trust? Well, I wouldn't trust anything right now. I wouldn't trust anybody, especially in the financial world. I wouldn't trust anything. Be very careful, because things are about ready to get a lot more insane, if you ask me. And let's get into the housing market a little bit here. I was one of the few channels out there saying there would not be a real estate market crash. Look at what happened in the first quarter. This is pretty amazing. Roughly 7 out of 10 metropolitan areas saw prices increase in the first quarter. Prices increase. This is hard to believe for a lot of people. People expected a crash. I mean, I can show you hundreds of videos saying there's going to be a crash. Mortgage rates have more than doubled. The average consumer's either tapped out or close to being tapped out. Who's buying all these loans? Now we have a credit crunch on top of everything else, right? So are the numbers being falsely reported? Who knows? But I do know that things aren't adding up, right? Things aren't adding up. Something's happening. Are whales coming in, mega investors, what we call whales, multi-billionaire companies coming in, buying up all the homes? Well, I don't see that either, because the last report I found shows that investor purchases had dropped off significantly compared to the previous quarter. So it's not investors either. Of course, there's always some investors buying, but they're not coming in and getting a bigger market share or buying up more homes than they used to. So as far as trying to justify the reason, the only thing it could be would be just more people taking on loans, taking on debt, buying homes they can't afford. I was watching a YouTuber earlier, ended up buying a home, I believe he was in Florida, and about a $1.3 million home, if I'm not mistaken. Took out $1 million loan, $1 million loan. Nothing wrong with taking out loans, but right now interest mortgage rates are very high, and you're a financial guru on YouTube, but you're taking out $1 million loan. Now, again, that could be a good financial move. If you take out a loan, the home increases in value, and then maybe you sell it a few years down the road for profit because of the equity. But does anyone think that even these small gains that we saw in the first quarter are going to continue, and that someone buying this year is going to make a profit a few years down the road? I think it's very unlikely. I mean, this is a dead cat bounce, in my opinion. I think a lot of people rushed out to buy a home. I think we saw a lot of panic and FOMO, fear of missing out. Because of the high mortgage rates, people figured, okay, home prices are not coming down. Mortgage rates are high, but mortgage rates might go higher. So I think a lot of people rushed into the market. And I know a few people like that just in my personal life. And I think that's a big thing happening right now within the home buyer community, for lack of a better term. So let me know what you think about that. What's the deal with 7 out of 10 metropolitan areas? Prices going up. Also, going back to the health crisis, a lot of people moved out of the cities. Now people are moving back into the cities with jobs, that have called people back. So I think that's part of it. And if you just look at metropolitan areas, I think that's a huge part of it. Now, overall, it's not so pretty. If you look at not just the metropolitan areas, but the country as a whole, most areas are seeing prices continue to drop, right? So not as fast as many expected still, but prices are continuing to drop. But I think we're headed for an avalanche in the markets, including housing, because when housing goes, the rest of the economy goes. There's no two ways around it, because this housing is so heavily tied to consumer spending. We know that consumer spending money is one of the main drivers of the economy. It's actually the main driver. It's about 70% consumer spending. And when home prices are going up, people are spending like crazy. They're remodeling, they're flipping homes. Flippers' profits have diminished. The rest of this economy is going down, and going down hard. Maybe not fast, but it's definitely going down hard. Next, let's talk about what Jeffrey Gundlach's saying. What he said here recently. Jeffrey Gundlach, Bond King, Jeffrey Gundlach. The Fed is done raising rates. That's what he says. So think about this. Inflation has not been tamed. Maybe it came down from 1 month to the next, but we're still way up year over year. We have not gotten back to the 2% inflation target. Even if we did, that's still not good, because that means prices are still going up. They're just going up more slowly. But we haven't tamed inflation. We're not even close to the 2% target, but yet they're talking about stopping the rate hikes. People out there are now saying the Fed's done. And we've been talking about they're going to be doing a pivot. They're going to drop rates. We just have to wait for the next shoe to drop, whether it's going to be more bank failures, which I think that's very likely, or something bigger. There's the debt ceiling drama that's happening. Maybe there'll be a partial temporary shutdown, and maybe that'll be enough to trigger the next dominoes to start falling, to have the Fed go out there and start emergency rate cuts. And if you see emergency rate cuts, guess what? There's going to be some major investing opportunities. I think metals will take off. I think a lot of digital assets will take off, even though you've got to be careful with digital assets, because they could come in and they can shut down your broker real quick. And look at all the people that lost their money in some of these other brokers that went down. So be careful with what you do with your money. As always, keep stacking, but stay safe with it. And we'll talk to you next time. Thanks everybody for being here. Bye for now. Peace.